Well, thank you and welcome for joining us this week for our weekly market update. Today is April 1st. We're recording a little bit earlier than usual, but we got a lot to cover, so let's get right to it. First and foremost, if you do have questions you want to see us answer on the call, service at o'harewealth.com, and you can always text us as well, 414-644-0060, and we'll try to answer everything as quickly and as concisely as we can, or we might save it for our upcoming chart party in a few weeks. First question. With all the tariff turmoil, should we be getting out of the market? I'm actually going to send this one down to our Florida office.
Thank you, JJ. Yeah, it's going to be 90 degrees here today in Florida. This is a good question and obviously top of mind for everybody with the tariff turmoil. There is a lot of turmoil right now. There's a lot of policy uncertainty, and that is having a dampening effect on the market. It's making investors question what earnings will be for companies this year. It's giving it a reason to pull back from the market. And the real point of this is normal. We've talked about it before. During any year, a 14% correction is kind of average correction. The S&P, I think, is down 4 or 5. I think it's 5% year to date. That's nowhere near the average. That's a very normal, reasonable correction. Actually, most of it's coming from the Magnificent Seven, not really the broad markets. But let's look at what happens, because from peak to trough, the peak of the S&P, it is down 10% from December when it peaked. And now 10%, what does that mean? Let's look at a chart. This chart will show what happened each time we had a 10% correction in the market. And this data goes back to 1980. Now, 1980 is 45 years. Quite frankly, that's our modern market. So this is, in my opinion, very good data to use. But again, it's the average S&P returns. What this chart shows is what are the returns after that 10% decline. And if you look at the top, recessions within 12 months occurred 7 times. No recessions occurred 14 times after 10% corrections. So we've had 21 10% corrections in the last 45 years. What happened afterwards? Well, the dark line shows you, that's the dark bar, is 1 month, 3 months, 6 months, 12 months. The market was down, flat, a little up, and flat. So if a recession does come, we probably won't make any money from here. But the market's already discounted the possibility of recession. So likely we're not going to lose a lot of money from here. So let's look at the 14 times, or the 2/3 of the time, where the market went down 10% and there was not a recession. Well, that's the light blue line. If you look out 6 and 12 months, it's pretty nice returns. 9%, 14%. That would not be unrealistic. Since we've had a 10% correction, we still have low unemployment. But consumers are still in good shape. Businesses are in good shape. We still don't see a recession coming. The odds are higher than normal. In any normal year, you have a 20% odds of a recession. I think Goldman Sachs this week raised their odds to 30 or 35%, but that's still, less than 50%. So a 9% or 10% recovery in the stock market through the end of 25 is not unrealistic, which means, we're going to have a flat to up year, which is kind of what we thought in the beginning. The other thing to look at, and this is looking at economic policy uncertainty. Our next graph, and we'll focus in on this. This goes way back to the financial crisis, the housing crisis. This is the Economic Policy Uncertainty Index. When you look back, the worst it's been was 2008. Well, everything was falling apart. The banking system was falling apart. It was terrible. That was also a market bottom. A few years later, 2011, I remember this. This was the European debt crisis, and the market went down 20%. So people were very worried. It was also a market bottom. in March of 20, it was COVID. And it was high uncertainty about policies. We didn't know what we were doing. We're shutting down the country. Much more drastic than some tariffs. But that was a market bottom. Now, as you look today, you know, we're having maximum uncertainty. Is this a market bottom? It possibly could be. I want you to understand that uncertainty long term is our friend. We shouldn't be scared and run away from it. This tariff issue, what the current administration is going to do, is going to be sorted out over the next 6 to 9 months. And I think long term, we're still in a very positive position on stocks. Let's see what the next question is. Now, this is a good question. It seems like my account has just been going sideways for a long time. Maybe basically the question is, should we just buy bonds since we get better yields on that now than we used to, instead of sitting in stocks? We're going to turn this over back to Wisconsin to my son, JJ, and he's going to answer this question.
Yeah, there's a couple of different things I guess I want to cover. I brought a few charts with me. So, yeah, there are lots of periods where the market goes sideways for a while. And I guess let's talk about a few of them, because I think that helps bring context to what's going on today. So this chart, I'm going to zoom in here, and you're going to have to use your imagination and draw some lines. But the very left-hand side of this chart goes from June of 11, right? And then it really kind of goes sideways until really March of 13. And people remember 2013 is a very good year in the market, and it was a fantastic year. But you went mostly sideways for a couple of years. And then you had a big run up. And then into 14, people were very excited. Investors were excited. People were telling me, all you got to do is buy stocks. About midway through 14, the market rally started to peter out, and we went sideways, right? Up until basically the end of 16. And remember, we had China slowing down. We had oil prices being too low. Those are those big dips there at the upper right-hand corner. But there was basically a 2.5-year period where we went sideways. More recently, right? The last couple of years before COVID, right? We remember 2017 is a fantastic market year, and it was. It was a 20+% up year. But 18, people forget what happened there. Remember, at the end of 18, we ended up having an issue with the Fed. They were raising rates too fast. Remember, we had the big, post Santa Claus rally. But if you look from really December of 17 all the way through June of 2020, it's 3 years where you went sideways, and there was no real progress. And you have to put that in context. There are periods of time where this happens in the market, when you draw these things directly across, where you don't see major moving averages move up. But if you ask me today, would I be interested in buying the S&P 500, right, at 2011 levels? The answer is yeah. I would be thrilled. What about 2014 levels, right before we went sideways? Yeah, I'd be thrilled. What about 2017? Again, thrilled. And yes, it's because you have to have that 5-year outlook. And so today, this is a market of the S&P 500. And this is very important, and there's a couple of things I want to mention. You look here, the market's been kind of sideways for a little bit. Now, the market's down about 5% at the time of this recording, year to date. But we peaked in 21. 2020 was a fantastic year. 2021 was a fantastic year. 2022 started off. And although the last 2 years we remember as being really, really good, we spent most of that time just digging ourselves out of 2022. Right? So although it's been good, we spent most of the time just recovering. Well, and most of that was concentrated inside the Magnificent Seven. So if you look back, we've been talking about this, the IBD Mutual Fund Index, which is the 20 largest mutual funds, is still down. I think it's down 27% from the old high in 2022. So most and the largest mutual funds are still down, much less not up. If you go look at the S&P equal weight, right, which we've been talking about a lot recently, the S&P equal weight didn't hit a new high until late last year. And today, although the S&P is down 5%, the S&P equal weight is basically flat. It's down 0. And guess what? The Mag 7, to draw the rest of the market down 5%, they're down about 15%. So it's exactly what we said a few months ago is they led the charge up and they're probably going to lead the pullback down. Remember, profits are perfectly related or near perfectly related, 0.97%, near perfectly related to market returns. But there are some times where they move separately, where they bifurcate. And usually what happens is we start marking time, right? And that's what happened in 2011 during the uncertainty periods there. It's what happened from 14 to 16. It seems to be what's happening now is we're marking time. Remember, we had good profits in 2022 and we had 0% profit growth in 2023, but we had a great market recovery. And what's happened so far this year? We started this year and said it was going to be a tough year to make money. Multiples were at 22 times earnings, and we were worried that would pull back. Well, guess what? Today, the S&P multiple earnings are like 20 times. It's exactly what we said. Even despite the fact that we expect earnings to be good, right? The multiples pulling back will pull down the larger, broader market, and they'll have a disproportionate effect on the stocks with the highest multiples, which is exactly what we're seeing happening. All that said, you got to take a 5-year outlook on stocks. And that's why, you can find these 2 and 3 year periods. There's a lot of them, by the way. If you keep going back in history, I could keep doing this lecture. But if you look back 5 years, what's today, April 1st? 5 years ago is 2020. We're 2 weeks off the COVID lows 5 years ago, right? How good have the returns been since then? They've been fantastic. You're annualizing like 15% a year, right? Since that, over that 5-year period. But 3 of those years have been, for the most part, mostly sideways, right? We only really started to break out in the middle of last year, and then it feels like we're giving some back right now. So how does this, conclude? What should I be doing next? You have to take a 5-year outlook, right? And again, just maybe we should have bought more bonds over the last 3 years. And by the way, we did for many, many clients. But saying we should have done more doesn't mean that also means what we should be doing next. You have to take a 5 and 10 year outlook on stocks. So if you take a 5 and 10 year outlook, the question is, do I think the market's going to be higher 5 and 10 years from now than it is today? And our answer is still, because of the questions about the economy and overall where the market tends to lead, we think the answer is yes. So with that, I'm going to conclude. Do you have any final points down in Florida you want to make sure I cover?
Yes, JJ, I just add, you made a great point there about correlation of earnings to the stock market. It is almost perfectly correlated over time. But you have to go 10, 15, 20 years to see that perfect correlation. On a 1 to 3 year basis, it's not highly correlated. And it's because people are waiting for the earnings. They're worried about something going on internationally or in the markets. So the sideways type action that we're talking about is going to always be with us. We're never going to get just a perfect stair step up type of market. And, this is not the time to run away. I believe the market will be higher in 5 years. I believe it'll be higher in 10 years because I believe corporate earnings will be higher in 5 years and 10 years. So with that, if you have a less than 5-year time horizon, we should be looking at different investments for your portfolio. But the part of your portfolio that's long-term, stocks still make sense.
Yeah, no, it's one of those fantastic things. It seems to continue to grow, and that's the growth we want to capture. And by the way, that's part of why you want to have a well set up allocation. That's what we talk to our clients about a lot, is being properly allocated for the time horizon for each individual asset. With that, we're going to close out because I know the chart party is coming up here in a few weeks, and that's going to be obviously a big one. It's going to be a much longer format. We're going to go through a lot of the topics we sort of briefly covered today. Our recommendation this 2-month period is Good Energy, which is about eating better and eating healthier. You can see our YouTube video on it attached in the corner. And with that, thanks everybody for joining us today, and we'll see you next week.